Investment.
Investment.
Investment. Investment. Investment. Investment. Investment.
Investment.
There are 4 asset classes, all with their pros and cons. The 4 asset classes are cash, property, bonds, and shares.
Cash. So I'm going to start with cash.
Cash is one of the lowest asset categories due to the price tend to being rather stable, not fluctuating, really.
Now, what I'd say important about cash is it's not completely risk-free as an investment. You've got to see that as it's got a purchasing power, it can be eroded by inflation, and the Bank of Building Society could run into its difficulty. So as you see, cash is in itself a risk to invest in.
However, the lowest.
Out of the 4, probably the lowest of investment there, because then it's only debatable about inflation and deflation and such like, or other of the 4 main things, not so much.
Bonds.
There are 2 types of bonds.
Government bonds and corporate bonds. Bonds issued when a company or a government wants to borrow money from investors. Interesting. They are normally issued for a fixed period and they pay back a fixed rate of interest each year. This could be positive or negative depending on inflation. Until the investor receives a capital back, you can invest in bonds by buying directly, but the more common way is to invest in bonds through a fund.
The more secure the government or company that issued the bond, the less risky the investment tends to be, because there is less chance of them not paying you back.
Good point. That's
However, the more risky, the higher the reward. The income paid on bonds will normally reflect not only the credit rating of the government or company issuing the bond, but also the current and expected interest rate. For overseas bonds, changes in the foreign currency exchange rates may also affect returns, sometimes significantly.
In addition, bonds have a short time until they mature, say less than a year. They tend to be safer than those with a long time maturity, longer than 15 years, which is common in large government bonds, which can be quite volatile. If you need to sell a bond before its maturity, it will be worth less than you paid for it. Bonds are extremely risky because they are dependent on inflation. If inflation is high, your bonds are worth nothing in a company where inflation is higher than your fixed rate. So it's a risky affair. Thank you.
Okay.
Checkmate. Property.
Many people consider their own property as investment. However, this is a disillusion, as this will only be effective if the person downsizes.
Recent past has shown that the housing market does fluctuate significantly. But on the plus side, by investing long term in a house, it can provide significant rewards. You've got, if you're letting, income coming in regularly, and you have the strong possibility, although not lately, of your investment becoming more and more valuable.
Oh. Well, in conclusion, we can say that investing in property merely depends on the location and size. For example, investing in a house in central London, rather low risk, keeping its value throughout the year. However, in rural areas such as big country homes, the price can fluctuate just because of people's needs and demands. Yeah.
Rematch?
Sure.
The Lord of the Rings. The return of the shares.
Most people invest in shares to try and get a better return, rather than, let's say, bank deposits return little.
To get a safe return, it's wise for an individual, by the use of funds and bonds, to invest in different countries, different companies, and different sectors. Ting.
In summary, different investments have their different pros and cons, as outlined in this video. Cheers for watching.
Lord of the Rings, the return of the shares.
Shares. Most people invest in shares.
The Lord of the Rings,
The Return of the Shares. The Lord of the Rings. The Return of the Shares. The Lord of the Rings. The Return of the Shares. The Lord of the Rings. The Return of the Shares.
Well, overall, property is, I would say, a medium risk investment, especially depending on the location, such as London being quite a
Turner, what are you doing?
Turner.
That's what it's about. That's what economics is about. That's what investing is about.